Welcome to lesson 15. Today we're going to be going over trade management. So trade management consists of these 4 topics: control risk, adjust your positions, lock in profits, and exit efficiently. And those are the 4 things that we are going to be going over today. We've got control. Cannot see because of this microphone. Risk. We've got adjustments as price moves. We've got lock in profits and exit efficiently. The first thing we're going to be going over is our risk. So you guys know that we do not ever have a stop loss placed at random. We always have a reason we are putting a stop loss where we are putting a stop loss. So under control risk, but never put stops at random. Always know why you are putting your stops at a certain level. Over here, I've got a little trade example here. I always place my stops above the previous lower high when I'm selling. I also like to put it just a tad bit above the area of interest, just so that it gives me personally a little more confidence in the trade. My stop is placed above the previous lower high because I'm selling. If I were buying, my stops would be placed below the previous higher low. For example, over here, let's say we caught buys over here, entered off this engulfing. We would put our stops below the previous lower high. It's our lower high and below those wicks. We target a 1 to 2, put us about right there. And that's if we're buying. Put your stops below the higher low and below the wicks. And same thing over here, we've got our previous lower high, which is going to be right here. And I went ahead and just put it above the my entire daily area of interest right here. And always give the trade plenty of room to move, just in case the trade is not ready. So let's say that you get in, you get your entry signal, you get your 30-minute shifted structure, and you get your 1-hour engulfing. You get into the trade, but price still comes back, and price starts consolidating, going up and down, kind of like so. So you get it, break, retest, and then price just does this right here, just consolidates until finally having the move. And sometimes that'll happen. You'll get caught up in consolidation phases. All you're going to do when you get caught in a consolidation phase is just continue to hold until the move does play out. So as long as you've got your entry signal, it doesn't matter how long it takes. It just matters about getting in when you're supposed to get in and then letting price do the rest of the work. And you are managing your trade while you're in the trade, making sure everything is going according to plan. It's kind of like managing a business. You're making sure everything is working, everybody's doing their job. Same thing with a trade, making sure that the 1 hour, the 30-minute, the 4 hour are all doing their job and continuing the trend. And if they stop doing their job, then you get out and you fire them. So we're going to be looking at our next point here, which is adjustment as price moves. Now, you won't always have to adjust your trade, but there are a few things that you need to be careful and watch out for just in case we have a reversal during the trade. So when price starts to either go in your direction or against where you're anticipating, this is where you are going to do absolutely nothing. You're going to let the trade breathe. The second thing, we are focused on protecting our capital. So we want to move our stops to break even at a 1-to-1 risk to reward. So how can we tell if we are at a 1-to-1 risk to reward? Let's see our trade play out here. So we get the break, we get the retest, entry signal, and let price do its thing, continue to hold it for however long. And all I do is I take my take profit until it gets to that 1, which is right there. So we're at a 1 risk to reward ratio. What I do is I just bring my stops to 0, and now the risk is completely gone. I am risking nothing now. Let's say I was risking 5,000 to make 10,000. Now I'm not risking a single dollar, okay? And I'm up $5,000 right now. Actually, more like 6,000 because our price is really down there. And as you can see, we continue because we're going to continue to hold our position till our take profit gets hit. And we still stay very, very bearish throughout this entire trade. So there's our take profit hit. So got to a 1-to-1 risk to reward ratio, and I no longer, just in case price did decide to come back and reverse on me, come take me out, any liquidity grab, anything, any high volatility news, I'm not losing anything. So it's either 0 or $10,000. I like that. It takes the risk out. And that's what we want to do. That's what I am trying to get you guys to understand, to protect your capital. Because I know that you guys work hard at your jobs. I completely understand that. Are you going to lose in the market? Yes. But are you going to have more wins in the market? Yes. Can you stop many losses from happening by putting your stops to 0? Absolutely. And you can always get back in the trade if you get your entry signal again. All right, so now let's dive into locking in our profits. As you know, to keep a very profitable and consistent compounding account, what you want to do is let price hit your take profit of a minimum of 1 to 2. I want to also talk about scaling in a position, another position, so that you can make even more on top of this trade. Now, I want you guys to know that this is a little higher risk because you are doubling down on a profitable trade. There's a difference between doubling down in a very negative trade. Let's say you're in drawdown a ton and you enter another position. Now you're starting to overexpose yourself, and that is not a good scaling position. A good scaling position is when you're in the trend, when you're in profit, scaling in another position to create more profits. But you want to do it at these certain areas. Okay, let's go back to where we're going to enter the trade. Okay, so we got an interest signal, we entered. Price is going in our direction. Now we have a slight pullback. So I would be looking to if I were to be looking into scaling account, and I don't do this very often, but it is something that you can benefit a lot from and get more out of your trade. Just know it comes with higher risk. So I would look for the previous structure point here, and I just make a little 4-hour area of interest. And I would make sure to do it with a 4-hour area of interest because it is stronger than your 1 hour, your 2 hour, your 30-minute, right? So go to that previous structure point, go 1, 2, 3. We got 3 little touches here to this area of interest. Let's say that we scale in another position here. So that means I'm going to apply more risk because now I'm going to have a stop loss because I'm not at a 1-to-1 with this position here. I'm going to target the same low as the other one and target a 1-to-2 risk to reward, which would be about right here. So here's my scaling in position. Say I scale in another $5,000. Now that I'm risking $5,000. And then price gets to this area. We enter the trade on this pullback of this 4-hour area of interest, scaling in a position. So now we're going to wait till we get a 1-to-1. Oh, we already have our 1-to-1. So what does that mean? We can now put this as 0. So now I'm not only up a bunch, almost $7,000 here on this position, but now I'm up over $5,000 on this position as well. That's another $5,000 that I'm in profit right now just by adding this position. And it is riskier, yes. But I've got my take profits here at 10,000. I got this one here at 10,000. So we continue to let the trade go. And again, there's no risk. I'm not risking a single dime anymore because I've got 2 positions here, my main position and then the one that I scaled in, that are now both at a 1-to-1 risk to reward. As you see, our take profits got hit. It would have been 10,000 here, 10,000 here, $20,000 trade. Perfect. So that's scaling in a position. And yes, you can also put your scaled in position at break even once that position is at a 1-1 minimum. And number 3 here, I'm just going to put let your winners run. All that means is let the trade do its thing. If it doesn't shift structure in all the lower time frames, the 1 hour, 2 hour, 30-minute, let the trade continue going in that direction because you're clearly in the trend. The trend is your friend. You are making those profits along with the trend. So let your profits run. Let it hit your take profit. Now we're going to go over how to exit efficiently. It's like we've talked about all these times when the structure breaks. First is going to be market structure break. So like down here, we are very bearish. And let's see, we get our break, we get our retest, our entry signal, price is going in our direction, price is looking good, price is looking good. Price comes up, gives us a little retest, we break, retest. Let's say we break below this low and price then, see now this gives us a new lower high, this gives us a new lower low. Let's say price breaks above this lower high. Now, technically, yes, it looks like we're going down, but we're actually starting to go up because now market structure has shifted in the 4-hour since we broke above this lower high. So we broke below this lower low. Now shifting this to be our new lower low, this next point to be our new lower high, and then price shifted above. More than likely, this market is going to continue to go this way right here. So what do we do if the 4-hour closes? Now make sure it closes and it's not just a wick. Make sure this is a body candlestick close above, because that is true market structure break. So market closes, 4-hour shifts right here. What do we do? Well, you can do one or two things. You can either get out, or you can continue to hold the position since we were at a 1-to-1 and we put our stops at 0. Continue to hold your position until you get taken out. Or, again, price could reverse again. And come back below, shifting the market bearish. So there's two ways that you can do that. You can either put your stops at 0, break even, or and let it just go and hit your break even. Because there's always that probability that price can turn back around, continue going in that direction. I hope that makes sense. I hope that I explained that well, because that will help you a lot in determining what you want to. And again, there's no loss at this point. You're either going to make 0 or nothing. What I typically do is I just let my trade continue to go. Now, take profits early after you get these market structure shifts, especially at a 4-hour. You can go ahead and take a little bit of profits and move on to another trade, or hope for the probability that the trade continues to go in your direction, or just wait till you get taken out in 0. That's typically what I do. But again, that's up to you. Either one works. You're not losing anything. You're just playing with probability at that point, but without the risk. I'm going to throw in some psychology real quick. Okay. One thing I see is letting your stops run. The more you let your stops run, the more you're going to lose. If price is heading towards your stop loss, just let it hit it. Don't ever risk more than you're willing to lose, but just let it hit your stops. Don't continue to let your stops continue getting bigger and bigger and bigger and bigger and bigger and bigger. That is the worst common mistake, and I've even seen some pro traders do this. Just continue to let price go down, 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 down. Just continue to go further, further, further. Like, let's say, they were at a 1 to 2 risk to reward. They were wanting to buy this market, let's say, and price just kept going, kept going, kept going into their stop loss, and was about to hit it, and then they pull one of those. Just continuing to let your stop prevent you from getting out. This is not what you want to do. I mean, look, now I'm at a 1-to-1 risk to reward, and let's say I'm like, all right, I'm done. Price comes, takes me out. I lose half of what I was risking. That is not a profitable strategy. Not in the slightest. So if you are in a losing trade, just let your stops get hit. Do not extend your stops. That's how you get a blown account. That's how you lose all your money. Another thing, do not let hope replace logic. Look at the trade for what it's doing. Don't try and make it something that it's not. It's either going to be a losing trade, or it's going to be a winning trade, or it's going to be a break-even trade. No harm, no foul. but always look. Don't try to make a trade something that it's not, and don't over manage trades. You don't have to be looking at it 24/7. You want to, of course, have it in the back of your mind all the time, but you don't need to be looking at it all the time. Don't over manage your trade. Look at it every once in a while. Look at it after every 4 hour close or something. Because if the 4 hour shifts, then that's a good indication that we need to get out or just let it hit our break even. But don't over manage your trade. Don't be looking at it every second of the day. Go out, do things. If you have a job, focus on your job. That's the good thing about swing trading. It works very well with a job. I understand you guys have jobs that you need to be at every single day. You need to put food on the table. You got bills to pay. So the one great thing about swing trading is you don't have to be on the charts looking at it 24/7. So it's actually really, really nice trying to escape your 9 to 5 by working on this throughout the day. And and there's nothing better at being at your 9 to 5. Let's say you make anywhere from $700 to $1,000 a week at your 9 to 5, and you look down at your trade and you're up $2,000. There's nothing better than that feeling right there. 100%, that is the best. I was at work one time, and I think I was making like $700 a week, and I was sitting there, and I looked at my trade, and I was up like $3,000. And I was like, whoa, this is almost a whole month's worth of work, and I had only been in the trade for about 24 hours. So, that's one of the best feelings is being at your 9 to 5 and being up a month's worth of work. I hope you guys have that feeling. I want you guys to experience that feeling. It is phenomenal. And then last but not least here in the psychological section, we are going to, of course, mention no revenge trading. Don't hop in a trade just because you lose to try and make your profits back. 9.999 times out of 10, it's going to backfire on you and you're going to lose even more money. We don't want that. So I'm going to bring all these down here so that you guys also have the charts to look at too. But this was your trade management lesson on managing your trades, when to get in, when to get out, and how to go about looking at the markets, what to look for, and when to put your stops at break even. Well, that's basically it for the trade management lesson. Let me go right here. I hope you guys understood this. I hope this was helpful. I want to get this trade in here too. That's also scaling in a position right here. I'm going to put it right here. Scaling in position. Right here. Remember that there is more risk when scaling in a position. But other than that, I hope you guys enjoyed that lesson on trade management. We're going to be jumping into lesson 16 where we are going to talk about how to grow a small account to a larger account that you are satisfied with, that you are happy with. So I hope you guys enjoyed, and I will see you in the next lesson.